Hello, today we're going to introduce revenue and expenses. Now, a business earns revenue by selling goods and or services. So for example, a gym earns revenue by selling memberships or selling apparel or selling the services of a fitness trainer or providing tanning bed rentals, that kind of stuff. So we're going to define revenue as money earned from the sale of goods or services. Now, by comparison, a business also spends money in order to operate. And these are costs associated with the normal operation of a business. And we're going to call those things expenses. So things like salaries or advertising or equipment repairs, okay? Costs associated with the normal operation of a business. Now, in accounting, okay, a company earns a net income if its revenue, the money it brings in, is greater than the money it spends to operate. So we call that a net income. And if revenue is less than expenses, then we have a net loss. Okay? Now, in accounting, okay, we don't put negatives in front of numbers. Okay? So if total revenue equaled 3,000 and total expenses equaled 5,000, we would have a net loss of $2,000. Okay? Now, we indicate the negative, it's negative by putting brackets around it. Okay? So we don't put a little minus sign in front of the 2,000. Now, we're going to introduce a new financial statement called the income statement. And income statement only shows revenue and expenses. It does not list the assets, liabilities, and owner's equity of a business. So an income statement is a financial statement that records the revenue generated and the expenses incurred, okay, by a company over a period of time. Now, it's not like a balance sheet, which is like a snapshot. Basically, okay, it covers a period of time, not a point in time. Now, that period of time is called an accounting period or a fiscal period. And it doesn't that it could be 6 months, it could be 1 month, it could be a year. It all depends on what the company decides to do, right? Or to set. Now, the accounting period is indicated at the top of the income statement. Okay, let me show you an income statement. Okay, so here's an example of an income statement. And you'll notice that the third line, it says for the month ended, or for the 2 weeks ended, or for the year ended. That's the accounting period covered by the financial statement or the income statement. So you have to indicate that time period. All right. Now you don't have to write projected. So you'll notice that it's 3 columns. The middle column is where the numbers will go, and then the totals will go off to the right. Okay. So usually revenue is listed according to what makes the company the most money down to what makes the company the least money. And for the expenses, I'm not going to worry about how they're ordered. You can just write them all down any which way you want. Okay? Again, so the total for the expenses are $12,250. So total revenue minus total expenses results in a net income in this case of $447,750. All right. Now, a couple of gaps related to revenue and expenses. The first one is the time period principle, and it is, or the principle of consistency. It's basically a rule that states that a company should set and consistently use the same accounting period. So you don't want to have an accounting period of 1 month and then 3 months and then 5 months. You want 1 month all the time, or 3 months all the time so that you can compare different periods, okay? Because if one financial statement is 1 month long and then the next financial statement is 3 months long, it's hard to compare those two financial statements. So if you're going to pick a month, always use a month. If you're going to pick a year, always use a year. Now, another gap or rule related to revenue and expenses is the matching principle. And it's basically a rule that states that the expenses of one fiscal period should only be compared to the revenue of that same fiscal period. So that's so to allow for comparison as well. So you shouldn't show the revenue for 3 months and the expenses for 1 month. Okay? There's a rule that says you can't do that. So if you're going to show the revenue for 3 months, you got to show the expenses for those same 3 months. Okay? All right. The next part is a bit confusing, so I'll explain it as best I can. Now, there's something called the revenue recognition principle. And basically, that's a rule as to when we're supposed to recognize revenue. And in the real world, there's something called the accrual basis of accounting. That's what's used in the real world. And it's got everything to do in regards to when revenue is acknowledged or recorded. So under the accrual basis of accounting or the revenue recognition principle, it's revenue when the service is performed or the sale is made. So we've performed the service or we've made the sale or the bill is sent. Not necessarily when the cash is received. Okay? So we record revenue when we perform the service or we send the bill, not necessarily when we receive the cash. And under the accrual basis of accounting, we record expenses when the cost is generated or the cost is incurred or the bill is received, not necessarily when we pay the amount. Okay? Now, there's also another method of accounting, and it's called the cash base of accounting, and it's kind of the opposite of the accrual base of accounting, and it can be used in some cases for tax purposes. You just have to understand that there's two different methods of accounting, and they do differ, but we're going to be using the accrual base of accounting. Now, under the cash basis of accounting, it's got everything to do with cash. So under the cash basis of accounting, revenue's recorded not necessarily when we perform the service or we send the bill. It's when we get the cash. And we don't record expenses when we receive the bill, okay, or we obtain the service. It's when we pay for the expenses. Okay, now this is confusing to some extent, but you'll kind of understand in the example below. Okay, so all right, so on top we have the accrual base of accounting, and underneath we have the cash base of accounting, and you'll notice that the numbers are exactly the same. Okay, so under the accrual basis of accounting, you have to understand when something is recorded as revenue. So under the accrual basis of accounting, it's revenue when the service is performed, not necessarily when the cash is received. So here we have services performed for cash are 1,000 and services performed on account are 500. So does this represent revenue? Yes, because we perform the service. Does this represent revenue? Yes, because we perform the service. So under the accrual basis of accounting, total revenue is 1,500. Now, let's look under the cash basis of accounting. Under the cash basis of accounting, services represent revenue when we receive the cash, not necessarily when the service is performed. So, services performed for cash, does this represent revenue under the cash basis of accounting? Yes, because we got the cash. Does this represent revenue under the cash basis of accounting? No, because we didn't receive the cash. So under the cash basis of accounting, 1,000 only represents revenue. Now, let's try expenses. Now, under the accrual base of accounting, it's an expense when the cost is incurred or the cost is generated or the bill is received, not necessarily when the cash is paid. So, under the accrual base of accounting, is this an expense? Yes, because the cost was incurred. Is this an expense? Yes, because the cost was incurred. It doesn't matter whether we paid it or not. It's when the cost was incurred. So, total of $2,300. Now, under the cash basis, it's an expense when I pay the cash, not necessarily when the cost is incurred. So, under the cash basis, this represents an expense, but this does not. Why? Because I didn't pay the cash. So in this case, our total expenses are only $1,100. Now, how does revenue and expenses affect assets, liabilities, and owner's equity? We're going to find out that revenue increases the value of the company or increases owner's equity. Okay? And that expenses decrease owner's equity. So again, revenue or net income increases owner's equity, and expenses and net losses decrease owner's equity.